Hi, Sravan. Hope you are doing well. As you know that last week we have covered Andes Limited, and today we have to do Julie Limited, the second portion of the consolidated statement of financial position. Okay, Julie's Limited. Okay, now we are going to question and we have to see either it's subsidiary or associate or what's the role of it's here. Okay, this what we have solved about Andes Limited. Okay, here was the question. Today, what we have to solve is about Julie Limited. Okay, this one. Okay, as you know about the question, property and plant, intangible assets, current assets, total assets, and so on, equity and liabilities, non-current liabilities, current total liabilities. We are not going to make any delay. Only here we need the ordinary share capitals of ND Limited and Julie Limited consist of share with a par value of 20 pence. Okay. First thing you have to remember, Julie Limited. Okay, Julie Limited share par value, shares par value for Julie Limited. Okay, you have to do this type of working so you will be easy point 0.20 or 20 pence. Okay, then you will be able to get mark. Then examiner would understand that student now or he has the concepts. Okay, here that's only important thing for us for Julie Limited. Now we are going to move on Julie Limited notes. Okay, that is the main thing that we have to solve. Okay. Now, EMA Public Limited purchased 300,000 ordinary shares in Julie Limited on 1st January 2024. Okay, look, as I have told you, the dates are very important. On 1st January, what's the year end? Year end is 30 April 2024. What's the start date? 1st May 2023. Okay, we do it right now. In a share exchange of one share in Emma Public Limited Company for four shares in Julie Limited. Okay, 1/4 exchange ratio. The share issue has not yet been recorded by Emma Public Limited Company. Okay, right now we know that Emma Limited Public Company purchased 300,000 shares. At what date? At this date. And we are gonna move toward our working sheet. Okay, first of all, what you have to mention, the most important thing, group structure. Group structure. First working. First working, you should be group structure. You have to understand what's the relationship of the company that we are acquiring with the parent. Okay. So group structure is very important. Then you can solve the other part of the question, group structure. As we know that EMA Public Limited purchased how many shares? 300,000 shares of Julie Limited. Okay. Now the next thing is how we can know that total number of Julie Limited share, total number of Julie limited share, Julie's limited shares. As you know that share capital divided by par value. Okay, we check the share value, share capital. It will be provided in the individual financial statements. Okay. Here is the share capital. Equity shares 100 for Andy, 800 for Emma, and 80 for Julie. Okay, 80,000. 80,000 for Julie, and here it's the par value 0.20. When you divide 248, and it will be 400,000 shares. Total shares, how much? 400,000 shares. So how much amount the EMA Public Limited purchased out of 400? 300,000 divided by 400,000 multiplied by 100, then the what amount come to us is equal to 75%. So we now know that if a company purchases 50% or more number of shares, then it will be treated as subsidiary. So in this case, for parent EMA Limited, the Julie Limited is subsidiary. Okay, it's clear right now. Now we are moving towards the date. Okay, for what date we are making the financial statement, consolidated statement of financial position? As we know that start date is 1 May 2023 and year end is 30 April 2024. Okay, and when did we purchase the Julie Limited? We purchased Julie Limited at, okay, a little bit further ahead. First January 2024, just 4 months before the year end. Okay, this is the most important thing because we need to apportion most of the things. Okay, just 4 months before the year end. Okay, another thing has got to be cleared. Okay, this is the most important thing. Now we are moving towards the next step. This is the working. This is the most important thing. You have to solve like this, please. Next time when I will give you task after completion of this question, you have to solve like this. Okay, and you have to send me. You don't need to make on Word. As your exam is paper based, you use paper and pen. You use the same, so your practice will be good. Okay. Okay, now the next in the note, for example, these two marks are cleared. 2 to 3 marks you're clear. Now next thing, the ordinary shares of any sorry, we are in the on 1 January, EMA Public Limited shares had a market value of 3.20 each. Now they have given the market value of EMA Limited shares. Okay, market value of EMA Limited shares is equal to 3.20 each. Okay, why is this important? Because this is how the EMA pays the consideration. EMA paid the consideration in the form of share exchange. EMA has like given 1 share and has taken 4 shares of the uh, Julie Limited. Okay, and this way we have to use the market value of EMA Limited shares in shares exchange. Okay. Okay, next we see on May retained earnings. Okay, first we need to calculate here. First we calculate here consideration paid paid by EMA Limited. Okay, where this will be used? This will be used in Goodwill. Okay, you can name it as working two because we are moving towards step by step. So, consideration by paid by EMA Limited. Okay, first thing, how we calculate in case of share exchange? What's the formula? We will use it. A number of shares acquired. Okay, how much number of shares are acquired? How many number of shares are acquired by EMA Limited? Multiply by share exchange ratio. Share exchange ratio, and then multiply by market value of parent share. Parent's share. Okay. Now the total number of shares, we know that EMA Limited has purchased 300,000 shares of Julie Limited, and share exchange ratio is 1/4, and market value we just dealt with 3.20. So the total consideration when you move 25,000, 75,000 multiplied by 3.20, it will come as, when you calculate, 2,40,000 pound. Okay, this is the consideration paid by EMA Limited. Okay, next step we have completed. Now we are moving towards the another step. Okay, third one. Okay, now the next thing is, on 1st May, they are telling us on 1st May 2023, the retained earnings of Julie Limited stood at 76,000. Okay, now next thing we have to do retained earning adjustment. Retained earning adjustment. They are saying on 1st May 2023, retained earning is equal to 76,000 pounds. 76,000 pounds. Okay, are you clear right now? I hope you are clear right now. As we have discussed above, starting date 1 May 2023, year end 30 April 2024. Please do this. When you solve any of the question, a practice question, do this way. You will be getting the maximum marks. I assure you, okay? And your understanding will be clear at all. There will be no problem in solving the question. When you go through step by step and follow these procedures, you will be getting the maximum marks. Okay. This is the start date. This is the year end when we have purchased 1st January 2024. Okay. What the retained earning they have given? They have given at the starting date of the year of the company, like Julie Limited, 76,000. And what we need here, what is at the date of acquisition? What is the retained earning value at the date of acquisition? Now the next thing is, what is the retained earning at reporting date? Okay, let's see. At reporting date, retained earning we can find in the individual financial statement, and here is the 97,000. Here is the 97,000. Okay, 97,000. Okay, what is the difference? What is the difference between the two? 76, 86, 96, and 97. This is the 21,000 pounds. What changes had occurred in the retained earning? 21,000 pound retained earning has increased by 21,000 pounds. Okay, now this 21,000 is gonna be divided into two parts. Okay, why two parts? It is gonna divide it into two parts in 8 months, for 8 months, and for 4 months. 8 months before the acquisition and 4 months after the acquisition, and we need the retained earning at acquisition. Okay, first we have to divide this 21,000 divided by 12 months and multiply by 8 months. We will get our 8 months retained earning. And how much is this? And when you calculate it, 21,000 divided by 12 multiplied by 18, this will come as 14,000. 14,000 pounds. Okay. And then the next one, like 14,000, 7,000 pound for the next 4 months. Okay. Now at the date of acquisition, we are able to put the value here, like at acquisition, what will be the retained earning at the starting date of the like company, when the year has started for the company, 76,000, and after 8 months company's retained earning has increased up to 14,000. So at acquisition, these two, when we add into each other, it becomes 90,000 at 1st January 2024. Okay, do you understand now how you have to calculate the retained earning at acquisition when it's like the matter of time when we have purchased? Okay, this is the third step we have done. Like, you have covered 5 to 6 marks till now, believe me. Okay, this working is what most important. This is the solution. When you will be able to solve this, the examiner will know that he has all the understanding, and you will get the maximum marks. Okay, now the next step is number 4. What we gonna do next? We are moving towards the notes, what's written there. We have solved the like 3 problems for Julie Limited. Think like financial consultant, business consultant, and you have the problems and you have to solve them for the company and for your client, whatever. On 1 January 2024, the ordinary shares of Julie Limited were valued at, like, this is the market value for Julie Limited share. Okay, market value for Julie, as a note we remember here, market value of Julie Limited share. This will be used to calculating the NCI at fair value, non-controlling interest at fair value. Okay, at acquisition, market value of Julie at 1 January 2024 is equal to 0.50 pound. Okay, now the next 4, what we are gonna calculate at the date of acquisition, the fair value of Julie Limited's, because we need to adjust this. Then we will be able to calculate the net assets of subsidiary, and then we will be able to calculate our goodwill. Okay, so first of all, no, this is the fair value adjustment. Okay, fair value adjustment at the date of acquisition. What is the fair value adjustment? Property, plant, and equipment was agreed to be 30,000 pounds higher than book value. 30,000 pounds higher than book value. Okay, means that this is like known as revaluation surplus. 30,000 pound fair value has increased. 60% of this fair value increases relates to buildings, and they are saying that 60% of this fair value increase, like, this is fair value, okay, basis on the basis of market value. 60% increase, this 30,000, from this 30,000, 60,000, 60% belongs to buildings. It means that its depreciation we have to calculate its depreciation. Okay, fair value adjustment has not been included in Julie Limited's books. Fair value has not been included, so we need to adjust it. And the buildings had an average remaining useful life of 12 years. Okay, the three figures are here: 30,000, 60%, 12 years. 60% belongs to buildings and 12 years. Okay. Okay, fair value adjustment. Fair value adjustment. Okay. And what's the fair value? Fair value increased by, as you know, that we have just viewed, 30,000 pounds. And this has two part, 18,000 and 12,000. But 12,000 may be about land, so it's not depreciable. Okay, this is about 18,000 belongs to buildings. Sorry. This 18,000 Okay, hold on. What's the issue? Okay, sorry about that. This 18,000 belongs to buildings. Okay. And this is about like land portion that is non-depreciable. And we know that useful life for the building is 12 years. Okay, now we calculate the depreciation for building. 18,000 divided by 12 is equal to 1,500 per year when you will calculate 1,500 per year. But you know that we remember when we have purchased the company, acquired the company, was 1st January 2024. So only 4 months depreciation is relevant to us. Only 4 months. We have to calculate only 4 months. Divided by 12 multiplied by 4 is equal to, this will come as 500 for 4 months. Okay. And then what will be the net book value? As you know that at reporting date, we book the asset at net book value. We write the asset at net book value. So net book value will be 18,000 minus 500 is equal to 17,500 pounds. Okay, then the total fair value adjustment at reporting date will be 17,000 plus 12,000. It will be equal to 29,500. Okay, this is the important. When we make consolidation, we have to add this fair value to our property, plant and equipment. Okay, that's clear. At acquisition, when we purchase, this is 30,000 at acquisition. Okay, now another remaining thing is intangible assets adjustment. Now next thing is about intangible assets adjustment. Okay, this we have solved, like we have solved the 8 to 10 marks question. 8 marks question. At the date of acquisition, EMA Public Limited valued Julie Limited's customer relationships. Customer relationships are treated as intangible assets because the value is measurable, identified, and it also has useful life. Customer base intangible assets at fair value of £12,000. EMA Public Limited has not accounted for this asset. So he did not account it for this asset. So it's our duty to account for. So we will account for trading relationships with Julie Limited customers last on average for 4 years. There are two number values that we have to remember. 12,000 is the customer base intangible assets value, and amortization is for 4 years and useful life is 4 years. So we need to go back and solve about intangible assets. Okay, intangible assets, customer base relationship, intangible assets value is 12,000, useful life 4 years, and when we calculate amortization, it comes as 12,000 divided by 4 is equal to 3,000 per year. But you know that only 4 months value is relevant. So we will have to divide 3,000 by 12 months multiplied by 4 months. So for 4 months, it will be 1,000 only. So it is the relevant for us. Okay. So at reporting date, what we have to mention at reporting date, we have to mention is equal to 12,000 minus 1,000 is equal to 11,000. Okay, this is the value at reporting date for the intangible assets. Okay, that's clear for you now. Okay, now let's see if any other asset is remaining to calculate. In March, Julie Limited sold. This is about pulp, and this is about intra-group transaction, and this is about final dividend. Okay. We are like halfway to our questions. Now what we have to calculate, the most important thing, net assets of subsidiary. Net assets of subsidiary. You can name it as working 5 or 6. Okay, working 6. What is the working 6? We are going to calculate net assets of subsidiary. That's most important thing. Most important. Okay, I have told you how to calculate like share capital. Like you have to calculate in 3 portions. Okay, then it will be very easy and best way. At acquisition, at reporting date, and this is about post acquisition. Okay, now we see share capital, share premium, and retained earning, fair value adjustments, and other reserves. Okay. Okay, now let's see share capital, where we can see we can find the individual statement. Net assets of subsidiary like Julie Limited. Julie Limited. You have to mention Julie Limited inside of subsidiary. This is a general one, so I'm writing this. Okay. Now we are moving towards the individual financial statement. Where is the Julie Limited share capital, equity share capital Julie Limited 80, share premium none, and retained earning 97. Okay, 2 figures, share capital 80, 97 retained earning. Okay, at reporting date, this is about the reporting date, 80,000, and share premium none, so none, and retained earning 97,000. So there were no change in the share capital during week because no new shares have been issued. So we will assume that it's the same at acquisition. So post acquisition, none. So retained earning, we have calculated the retained earning adjustments above. So we know that retained earning adjustment is here. So at acquisition, it comes as 90,000. We will take this figure to down. At acquisition, retained earning was 90,000. Now the fair value adjustments. There were two fair value adjustments. Case of property, plant, and equipment. And second thing was about intangible assets like customer base relationship. Customer base, okay? Customer base. Property, plant, and equipment, as we know that there were 30,000 figures at acquisition, it was 30,000. And intangible assets, customer base, we know that at acquisition, it was 12,000 figure. Okay, it was the figure of 12,000. Okay, now we know that we have calculated it for at reporting date. At reporting date, what we have calculated for the like customer base, it's 11,000, and for the property, plant, and equipment 29,500. So at reporting date, it was 29,500 and it was 11,000. So what is the like post acquisition difference? Like after purchasing the company, what progress we have made? Like post acquisition retained earning was 7,000. Post acquisition like depreciation from the asset 30,000, 29,500. This becomes less. And intangible asset, it's reduced from 12,000 to 11,000, so 1,000 amortization. So here we go. Here we will be able to calculate our total. Okay, at acquisition, when you calculate 80, 90, 30, 12, it will become 2,12,000. And next one, at reporting date, when you will calculate all this, 2,17,500. And the post acquisition difference will be 5,500. Okay, these are the three we need to solve the remaining question. This is the most important thing, most important. Okay, now we will calculate a lot of things. All our working will be completed by this. Net assets of acquisition, subsidiary at acquisition, at reporting date, post acquisition. Okay, this is the most important thing in the consolidated statement of financial position, most important step. Now we are gonna moving to calculate the goodwill. Okay, number 7 working, you can name it is as goodwill. Okay, goodwill. As you know that consideration paid, what is the formula of goodwill? Consideration paid by parent, consideration paid by AMA, and we have calculated it, and then NCI at acquisition, NCI at acquisition, NCI at acquisition. What is meant by NCI at acquisition? Total shares multiply by NCI percentage, non-controlling interest percentage, then multiply by it market value of shares, market value of subsidiary like Julie shares. Okay, total number of shares we remember 400,000 multiply by non-controlling interest percentage as 75% is the holding percentage by Emma, so 25%. Okay, then multiply by Julie Limited market value of share we have noted above as 0.50. Market value of Julie Limited, this one, 0.50. Okay, 0.50, point 50. Okay, when we calculate like this will come as 100,000 multiplied by 0.50 is equal to 5,000. Okay, it will come as 5,000. Okay, then less what we have to less net assets of Julie at acquisition as we have calculated just right now. We have to less this 2,12,000. Okay, now the consideration paid by Emma Limited we have calculated above in the first or second or third step, I think so. And this is the consideration paid by Emma Limited, that was share exchange way, and this is £240,000. £240,000 plus NCI at acquisition. Then our goodwill at acquisition is, when we calculate this, it comes as 33,000. Okay, 33,000. Sorry. Okay, goodwill. We have calculated the goodwill. Now we are moving towards the next step. Okay, next step is like Julie Limited sold some things. In March 2024, Julie Limited sold 36,000 worth of goods. This is cost. Okay, this is cost. Worth of goods mean goods value. Goods value is 36,000. We need selling value. And they have mentioned profit markup of 20% for all sales. And they have mentioned Emma Public Limited has 25% of these goods within their inventories. 25%. Okay, as I think you also have calculated this one. Okay, three values are important here: 20% markup, 25% remaining, and 36,000 cost. Okay, next we are calculating perp for our working 8. Working 8 mean perp. Okay, we are gonna calculate perp. There are like cost of goods. Cost of goods is 36,000. And out of 36,000, 25% are still in inventory. So I think we have to calculate only perp only on this amount. So 36,000 multiplied by 25%, it comes as 9,000, because other have sold like 75% portion of the uh, things have goods have been sold to the external party, so that's profit has been recorded. So the 25% is remaining inside the companies, so we need to adjust, eliminate that portion of perp. Like this is not good, like intra-group transactions we have to remove. This is like unrealized profit, like one hand is selling to another hand, like one body is doing transaction with another body. Okay, so this can't be happen in consolidation. So cost of goods Like for now, we have 9,000. So, and markup, profit markup is 20%. So we can calculate like this: cost plus profit is equal to sales. So cost is 9,000, profit is like 20% markup, and sale will be like if you move like this way, 100 plus 20 is equal to 120. So we need to divide 9,000 divided by 100 multiplied by 120, and it will come as 9,000 divided by 100 multiplied by 120. Then it will come as no, 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 no. Oh, if we are calculating sale price, we calculate directly profit. 9,000 divided by 100 multiplied by 20. This will come as 1,800. Okay. 1,800 pound. This will be the PERP, PERP, provision for unrealized profit. Okay. This we have calculated the next steps. We have to adjust PERP double entry. Do you remember? Credit inventory. We remove the PERP from the inventory and tab it retained earning, and we remove the same amount from the retained earning. Okay. We reduce the inventory and reduce the retained earning. Okay, in case of like retained earning and NCI portion of PERP. Now the next step, we are gonna calculate the next step. On 28 April 2024, like before the year end, Julie Limited a check for 40,000 to clear year-end intercompany balance between the two companies. Intercompany balance. The check was not received by Emma Limited, so this amount was regarded by one company as receivable and another company as payable. So we need to remove this transaction at all. So we will remove it by reducing the receivables by 40,000 and reducing the payables by 40,000. Okay, intergroup transaction. Intra-group transaction. 40,000. We will reduce it by debit account payable by 40,000. And similarly, credit account receivable by 40,000. Now the last step that will be going to our working 9. Working 9. About the final dividend. Declared a final to 26 April. This is also before the year end. Sorry. This is also before the year end. IMA Public Limited has not taken credit for its share for the dividends from the Julie Limited in the statement of financial position above. So, first thing, these 20,000 has been declared as dividend by Julie Limited, but IMA Limited has not recorded. IMA Limited has not recorded at all. It means that these are not included in the account receivable. So it is good thing. It is good thing that IMA Limited did not record. So in the group transaction, we don't record. We remove it because it's like the same body transaction. So we remove it. So what we have to do, only it's recorded in the Julie Limited records 20,000. Okay, what we will do, as you know, previously you have also 20,000 done. You also have done this type of transaction, final dividend declaration 20,000. So we need to apportion it in two parts. Okay, as Emma Limited did not record into the account receivable, only this is the Julie Limited sides, what Julie Limited has recorded. So this will be adjusted in one way. Okay, but two portion like 75% and 25%, as 75% related to Emma Limited company controlling group, like 15,000 and 5,000 to NCI. So Julie Limited, as Julie Limited has recorded it into account payable, so we need to remove 15,000 from the account payable, as it is intergroup transaction, intra-group transaction. 15,000 remove from account payable. Okay, and 5,000 will be there as it will be liability, as it's to external to the group. 25% NCI, non-controlling interest percentage. Okay, we have solved all the problems regarding Julie's Limited. Okay, we have cleared all the problems for the Julie Limited. Okay, now if we solve for the Julie Limited, we can solve it easily. Like for example, what you have to do, property, plant and equipment is equal to like parent plus subsidiary like Andy plus Julie. Okay, please, you have to solve like this. You have to solve the whole question like this, and you have to send me the file. Okay, must. As you know that previously we have solved our Andy's Limited, like we have done for the here property, plant and equipment 380 plus 150, 380, like this is the for the parent plus 150. Then what is for the Julie? For the Julie, we need to move towards here, and here, we need to go to the individual financial statement. We move, and we need to go to property, plant and equipment. And here is the Julie Limited value 70,000 plus 70 plus, for Julie Limited, another thing, fair value adjustment in at reporting date. Okay, sorry, I was going to write the at acquisition, but reporting date it's 29,500. 29,500. So it's here 29,500. Okay, this will be the come as total. Okay, similarly, when it comes to the like intangible assets, similarly, parent, you have to mention here for the parent like Emma. Emma is the parent. Emma plus Andy, and we have calculated for the Julie intangible asset. We are moving towards the like intangible assets is here 8, and plus we know that 11, 29.5. If we are like mentioning figure in like thousand above, so we need to write 29.5k. Okay, 8 plus 11, 11k, 11,000 was the intangible assets adjustment, like customer base relationship, that has not recorded by Julie Limited. Okay, then you have to do the total. Okay, then the next, for example, goodwill. Yeah, goodwill we have calculated for Julie above. Goodwill at acquisition 33,000. Okay, 33,000. how do you write? You had the goodwill of the Andy plus goodwill of the what you can say Julie. Goodwill of the Andy and goodwill of the Julie. Julie 33,000 and Andy we have calculated before. Okay, what's the main thing? We need goodwill at reporting date here because we are making final. So for the Andy Limited, we have calculated the goodwill at acquisition. Okay, I want to adjust for that for also. Goodwill at acquisition, goodwill at acquisition, goodwill at acquisition. Okay, goodwill, this is at acquisition. This is at, okay, this is at acquisition. This is at acquisition. So what will be at reporting date? We need to review the goodwill, either it's impaired or not. So in case of the Andy, we have given in the question that goodwill has been impaired in the last notes, in the goodwill notes. Okay, today, because today we have to complete this question. So this Andy's limited goodwill had been impaired by £18,000. There was no impairment in Julie's limited. An impairment loss of 200,000 is to be recognized in investment in Alex Limited. Okay, in Alex Limited also. But now we are doing the Julie Limited. Andy Limited of the one step only 18,000. Okay, impairment 18,000. We need to remove this and then our goodwill 13 minus 8, 5, 19, 1, 18. Okay, 1,85,000. This will be goodwill at reporting date. This will come as low, like you can write in consolidation goodwill 1,85,000 plus 33,000 is equal to, this is total. Okay, do you understand? Please solve this question like this, please. Okay, similarly, current assets, case of inventory for Julie Limited, Julie Limited, inventory, what you have to remove from the inventory? Inventory of the, like you put the Julie Limited amount from the individual financial statement. Inventory 1,12,000, 1,12,000. Okay, like you have to mention parent plus Andy, like in the previous we have done. Okay, plus Julie. In case of Julie, there is 1,12,000. What you have to minus? Alhamdulillah. Sorry. Okay, in case of the Julie, this is the individual financial statement transaction, and you have to remove the PERP minus 1.8K PERP. Okay, then you have to add up together parent plus Andy, Emma plus Andy, and then Julie. And this will be total inventory. Similarly, in case of the trade and other receivables, what you have to remove? You have to remove the intra-group transaction. Intra-group transaction, here above we have studied for the £40,000. £40,000, okay? Trade and other receivable. Okay, receivable value, Julie's limited receivable, from where you pick up, individual financial statements, and then you have to remove £40,000 intra-group transaction, and then total. Per Emma plus Andy. Okay, please, you need to complete this. This is just a structure. So this is your task to complete and send me. Send me like this how I am solving. Okay, you need paper and pen and you have to complete this and send me, please. I will review it and mark it for you. Okay, Then bank will be at the same, no adjustment here needed, only pick up from the, okay, we see the total trade in other receivables and bank value from the ND limited trade in other receivables, 78, and there is bank with 33, 78 and 33, okay, 78,000 less 40,000, as we are moving like thousand figures above, so we are not gonna write any thousand with our figures. Okay, 40,000, 40, 78, 78 total receivable, then 33 bank, and we have to add MO plus ND, MO plus ND. Okay, this is your task. You have to complete it. Now the next important step, like, you will be total assets here. Then we are moving towards the equity section. In equity section, what's the important? Share capital only parent, share premium only parent, only parent. This you have to remember, only parent, because subsidiaries are under control of the parent. Okay, and the next step will be here, like, we have to calculate retained earning, group retained earning. What will be the formula? What will be the formula? Like, post acquisition net assets, post acquisition retained earning or net assets of subsidiary, post acquisition net assets of subsidiary, multiply by controlling percentage, controlling percentage. Remember the formula, please. Okay, then minus perp, then minus perp. Okay, here, as we know that post acquisition net assets, I have said to you, this is very important. This is very important. Post acquisition net assets here, 5,500. Okay, post acquisition net assets of subsidiary is equal to 5.5 multiplied by 75% and minus perp is 1.8k. Minus perp is 1.8k. Okay, like retained earning, you know that parent EMA. Now, if total we are calculating plus ND, EMA and ND we have calculated in the previous lecture, and now we are calculating for Julie Limited, EMA plus ND plus Julie. Okay, now we are calculating for Julie, and here 5.5 multiplied by 75%, and like, you have to calculate this, please. Okay. Okay, if you want, I can do it for you, but it's gonna take time. 5.5. This is like just calculation formula is in front of you. 5.5 multiplied by 75, 4.125 minus 1.8, 2.325. 2.325. This is the retained earning of the group, like plus ND and plus EMA. This, like previously you have calculated that the total group retained earning this will be. Similarly, NCI at reporting date will be equal to NCI at acquisition, as we have calculated about 5K, I think so. Yeah, 5K, like the figure 1,000 are above. Then plus post acquisition net asset of subsidiary, net assets of subsidiary multiply by NCI percentage, and NCI percentage is, as you know, that 25%. Post acquisition net assets of subsidiary are like this one. Like this 5.5 will go into the two portions, because this is whole related to the Julie. So Julie is 75% goes to the group and 25% goes to the NCI group. So 5,000 multiplied by 5.5 multiplied by 25%. So 5.5 multiplied by 0.25, 1.375 plus 5. So it will come as 6.375. Okay. Then similarly, NCI percentage in case of Andy, also in together, like we have calculated in the previous. Similarly, in case of liability, as you know, the above steps, we don't need to any adjustment in these, like borrowing, tax, deferred tax. We did not need to adjust any of these things because we have not seen any of these things. Just put EMA plus Andy and plus Julie from the individual financial statements and add up together. This will be add up together. This will be our overdraft. Similarly, add up together. This is like now current liabilities, overdraft, add up. Emma, Andy, Julie, add up together. Just you need to add up. And similarly, trade and other payables. From here, you have to remove some of the transaction as you have studied. In case of the Julie, first take the individual financial statement transaction. What is the individual financial statement transaction of Julie? Emma, Andy, we have calculated previously, and for Julie, we are calculating now. For example, we are going to Julie, trade in other payables. Julie 74, 74, 74, 74. Julie trade in the paper 74. You know that you have to remove the intra-group transaction and dividend, final dividend. Intra-group transaction 40K, remove 40K, and for dividend you have to remove minus 50. So this adjustment is needed. So add up together plus Andy plus Emma plus Andy plus Julie and total trade. Now total liabilities, total equities, total assets and calculate all. Okay, total liabilities, total assets. This is what we have completed our question for the subsidiaries. Now the next last thing for the associate. If our next one is associate or subsidiary, we have to check first and then. Now we are gonna solve for the Alex. Alex. Now let's check. Alex Limited is associate or subsidiary. And what we have to do for that one, if it's associate or subsidiary, then what we need to do, Alex Limited, Alex Limited, Alex Limited. Now we are going to study Alex Limited. EMA Public Limited paid £60,000 to acquire 80,000 shares in Alex Limited on 1st July 2023. Look the date here. This also needs time apportionment where necessary or where required. Okay, we see 60,000 to acquire 80,000 shares in Alex Limited on 1st July 2023. Okay, now we are moving toward Alex. Here is Alex Limited. EMA purchase 80,000 shares for £60,000. Okay, and purchase date was 1st July 2023. So as we know that our year Start date is 1st April. Oh, sorry, 1st May 2023. Year end is 30 April 2024. So when we get 1 May, 1 June, 1 July. 1 July 2023. So we have purchased it like for 10 months before the year end. So we need adjustment of 10 months in many of our working. Okay, now let's move further. First, we see either it's our subsidiary or associate or what. Okay, IMA's so far that we have to calculate the total shares of IMA. For that, we need share capital plus par value. And share capital plus par value we see from the question. Here will be on the top in the notes. First two we have given the share value, and it's 40 pence par value. 40 pence par value for Alex Limited, and the second thing is share capital of Alex is 80,000. Okay, we move towards 80,000 divided by 40p, and this will come as 0.40 like pounds, and this will come as 200,000 shares. This will come as 200,000 shares. So out of 200 shares, EMA bought 80,000 shares out of 200,000 shares. So it will become as 40%. 40%. So it's under the 50% threshold. So it's now treated as associate. So for associate, what we do in consolidation, single line treatment. We do in the consolidation, single line treatment for associate. That is known as equity accounting. Equity accounting. Equity accounting. What we do, we need to calculate the for the associate, we need to calculate investment at associate at associate at reporting date. At reporting date, and then we put this investment of associate at reporting date under the headings of non-current assets. Okay. In the consolidation, investment at associate at reporting date. So what's the formula to calculate? Investment at acquisition, what we have paid to acquire the company, plus post acquisition share of profit. So what we get after like 10 months from the associate minus we do per if any of that. Okay. Now we see in the question like what's in the notes to solve to reach this formula, like to calculate this formula, what we need, like investment at associate, we know that investment at associate at acquisition, we have done 60,000 pounds. Now the next, we need to calculate post-acquisition share of profit and perp from where we can get. We need to work for this. There are notes. Okay. There are notes. There are notes in the question. For the Alex Limited, we see and move on. Alex Limited. On 1st May 2023, the retained earning of Alex Limited stood at £20,000 on 1st May 2023. On 1st May. Okay, now we are moving towards retained earning calculation.